Let me show you something that most investors completely overlook. Imagine I offered you a bet. You risk $1, but if you win, you make $5. And you only need to be right, let's say 30% of the time. Would you take that bet? Most people would hesitate. It doesn't feel comfortable due to its low win rate. But mathematically, it's a very profitable outcome. And this idea of asymmetric bets sits right at the core of how I think about investing. So what is an asymmetric bet? At its simplest, an asymmetric bet simply means you risk a small amount for the chance to make a much larger amount. Your downside is limited, but your upside is open. Now compare that to how most people actually invest. They tend to hold on to losing positions and sell winning positions way too early. So they end up with small wins and some large losses. And that's the exact opposite to asymmetry. And over time, that's very hard to compound. So as a simple example, let's make it concrete. Imagine you have two strategies. Strategy A wins 80% of the time, but when it loses big. And then you have strategy B. It wins only 40% of the time, but when it wins big. Most people instinctively prefer strategy A because it feels safer. You have more winning trades, more consistency, more opportunities to be right. But with strategy B, it's often more profitable over time because the winners are often much larger than the losers. So it isn't about being right all of the time. It's about what happens when you're right versus when you're wrong. And financial markets naturally create opportunities for asymmetric outcomes and bets. But occasionally, stocks don't just go up 5 or 10%. They'll often go up 100%, 200%, or sometimes even more. But importantly, a stock can only go down in theory at 100%. So your downside is capped, but your upside is potentially very large. And this is why certain strategies, particularly trend following, are built around capturing these large moves. They're not trying to win every trade. They're trying to capture a few big winners that really matter. And this is where systematic investing becomes really powerful because rules, as we've said on previous videos, remove emotion from the process. So taking a trend following system as an example, it'll enter when strong moves begin and it'll exit quickly if trades fail, but it will stay invested if the trend continues. And most trades in that system are small losses or even small gains, but occasionally the stock will enter a major trend and the system stays invested for the entire move. And those few trades generate very large returns, and that's asymmetry in action. Now there's another way to think about this idea which makes it even clearer, and that's something called positive skew. Don't worry about the terminology for now, but the idea is simple. Imagine lining up all your trades from worst to best. Most of them are going to be small losses or small wins, but in that trade distribution, you'll occasionally find a few large winners. And this creates a distribution whereby most of the outcomes are small, but there are a few extremely large winners, and that's positive skew. And this is exactly what good asymmetric strategies produce. And you can actually see this clearly in real data. If you take a back test and look at historical performance in a trend following system, you'll find that only a small number of trades, sometimes as little as 5%, account for the majority of the total returns. So in other words, most trades don't matter that much, but there's a handful of big winners that drive almost everything, and that's skew in action. Now compare that to how most people actually invest. They take profits too quickly. They hold on to losers thinking they'll turn into winners. So the results look like this. Lots of small wins and a few very large losses. And that's negative skew at play. And over time, that's incredibly difficult to compound. So when you look at a strategy, it's not just about win rate or average return. It's about the shape of the outcome within the distribution. Because the shape determines how the strategy behaves over time. And the reason this is so hard in practice is psychological. We don't like being wrong. Taking small losses repeatedly feels uncomfortable, so people try to avoid it naturally. They hold on to losing trades thinking they'll turn into winners, and they take profits quickly to feel right, but the behavior destroys asymmetry. Instead of small losses and the occasional big winners, you get small winners and the occasional large losses, and that's where most investors struggle. If you zoom out, this idea becomes incredibly important because long-term performance is not driven by how often you're right. It's driven by how much you make when you're right versus how much you lose when you're wrong. And if you consistently structure your decisions so that losses are controlled and upside is open, you don't need to be perfectly accurate. You just need to be disciplined over time. And there's actually a deeper concept behind this that we'll cover in a future video. There's a lot of traditional thinking in finance that focuses on averages, what happens on average across many different scenarios. But as an investor, We don't experience averages. We experience one single path through time. And if your strategy exposes you to large losses along that path, you may not be able to survive long enough to realize those average returns. And asymmetric strategies solve that problem because they're designed not just to look good on paper, but to actually work in the real world over time. So the next time you think about investing, don't ask, am I going to be right? Ask yourself, is this an asymmetric bet that fits my system? Because if you consistently put yourself in situations where losses are small and gains can be large, you don't need to be perfect. You just need to be consistent. And that's exactly what systematic investing is designed to do.